Let me take that across to Mark Mathews, actually. We have a great conversation going this morning. He's Head of Research Asia at Julius Baer. Mark, very good morning to you from where we are here in Mumbai. Always a pleasure to speak with you. Just sort of to get your sense going in, let's start with your view on what's happening in the American markets. An astonishing bull run going on despite everything. Do you think, first of all, that's sustaining and enough signs that the Fed has to ease rates at the next meet?
I think it's sustaining in part because the Federal Reserve will be embarking on a rate cut cycle, and we're looking for a rate cut at each of the three meetings that will happen between now and the end of the year. And then, by the way, we're looking for two more in the beginning of next year. So that's usually a good thing for stocks. And then the other thing is that the earnings in the US have been much stronger than anticipated, both in the first and second quarter. In the second quarter, the earnings growth for the S&P was 12%. Back in the summer, the consensus was only looking for half that. So I do think that the combination of these two factors will continue to take stocks in the US higher. But on the other hand, it is clear, especially for non-dollar based investors, that other markets in the world have done better than the US, principally China and in Europe. And so there's more of a mood to diversify this year than there was in the last few years into other parts of the world.
I'm wondering how you're looking at emerging markets and India right now, Mark. We've just come off a big reform and recalibration of the indirect tax here, the GST. And that's expected to give quite a boost to consumption. Drastic cut in tax rates for common everyday essential items as well. Does that change the view on India?
Yes, at the margin, it makes it even better. So we do like India, and in light of the GST revisions, I would say that there is a reason to like it more. In the past, really, it started with the balance of payments crisis in 1991. There have been so many episodes where whenever India does have problems with its economy, the net effect tends to be positive because the government embraces even more pro-business and pro-market policies, and we're seeing that play out as we speak today. So I think the backdrop in India looks good, and I also think that there is a growing trend for investors around the world to give emerging markets another look. They don't really invest in the small ones. As you may know, most emerging markets are small, countries like Indonesia or, I don't know, Chile, Mexico. If you're a investor in the United States or Europe, you're really going to either pick India or China. And so I think both look good, and I expect both to do well over the next 12 months.
Okay. Mark, hi. Morning, Alex here. You spoke about the number of rate cuts that you anticipate from the Fed. And of course, you've seen some of that being reflected in the bond yields in the recent past, 4.15 for the 10-year Treasury. If the rates are going to go further lower, and the implication, therefore, is that yields will cool further, traditionally, you've seen money flow out into risk-on assets, into risk assets. And so therefore, I'm wondering what you think about the capital flows heading into the next year and the start of 2026.
The thing that complicates this is the tremendous volatility in policy in the United States. And that has global implications, of course, through tariffs and geopolitics. So ordinarily, you would expect with a series of rate cuts from the Federal Reserve that the Treasury yield should go down. We're not forecasting that. We're looking for the 10-year Treasury a year from now to be more or less where it is now at about 4.2 because of this political uncertainty. And it dissuades a lot of people from investing in the U.S. And I might add with the tariffs that if the Supreme Court does uphold the ruling from the appeals court that the tariffs are in fact illegal, then the deficit in the United States looks a lot wider than economists had been forecasting it, which would also imply a high treasury yield. So anyway, there's lots of moving parts, but if I was to summarize what I was trying to say, what I would like to say is that actually, as much as the public sector looks pretty volatile and uncertain right now, the private sector is doing well. As I mentioned, 12% earnings growth in the second quarter in the S&P 500 companies. And to my mind, the economy in India is doing quite well. And in China, I believe their economy is going to start to pick up. So put it all together, I see a good trajectory over the next year.
Mark, I don't know how good morning, of course, Neeraj here. I don't know how strong a view do you have on the cycles in India, but there's a lot of thought, a lot of talk around how this consumption boost that has come in from the government, the income tax cuts earlier and the GST now, could eventually lead to a private capex uptick because all of these consumer-facing companies will want to set up capacities. Any thoughts there?
I hadn't thought about it until you told me that. I mean, intuitively, yes, some of these tax cuts are very, very significant for fast-moving consumer goods and for insurance. Possibly, yes. I don't see why not. If suddenly there's a lot more demand because instead of paying 18% tax for something, you're paying 0 for a certain product or service, then intuitively, if there's more demand, companies need to think about expanding capacity. That makes sense to me.
Got it. Mark, one more question is, how India, now that there is an attempt, and a serious attempt done by the powers to spur consumption and thereby spur earnings growth in the second half. Now, does that, relative to the rest of the Asian or the EM pack, bring India back into the reckoning of the foreign institutional investors? Or do they have enough cheap markets out there to invest instead of investing in India?
Yes, I think it should bring India back into greater focus. China was cheap. It's not really so cheap anymore. It already went up 25% last year. It's up about 25% this year. It's certainly cheaper than India, but for good reasons. The return on equity is much lower in China than in India. And as you know, their demographics are very much a different story. They're declining, whereas India's is rising. So yes, I think that to go back to what I said earlier, most investors, if they're picking a country, they're only going to pick a very large emerging market. And there are really only two, which are China and India. They're not going to put money into any of the smaller ones. So I believe that India would benefit from that, but also many investors obviously invest passively through ETFs. And if you're buying an emerging market ETF, you're going to be buying a little India as well.
Mark, absolutely. Thanks so much for joining us this morning, and pleasure speaking with you as always.